Welcome to the Bull Strangle Strategy. Our approach combines stock ownership with systematic option selling to generate income while maintaining long-term market exposure. Every trade follows a repeatable process built around stock selection, premium collection, risk management, and disciplined execution. Let's get started. One of the most important decisions in the Bull Strangle Strategy happens before a trade is ever placed. It's stock selection. Most traders spend significant time evaluating option premiums, strike selection, and trade management. Those factors certainly matter, but over time I've found that the quality of the underlying stock often plays an even bigger role in determining long-term results. Over the past year, I've been conducting an ongoing research project to identify the characteristics most commonly found in the strongest bull strangle candidates. The goal isn't to predict which stocks will generate the highest returns. Instead, the objective is to identify stocks that consistently exhibit the traits that support successful option selling performance: stability, liquidity, institutional sponsorship, and manageable volatility. Using hundreds of historical bull strangle trades, I've developed a ranking system that classifies stocks into several categories, ranging from core and elite candidates to stocks that generally fail to meet the research established standards. The early results have been encouraging. As stock quality improves, average returns tend to increase while the frequency of large losses declines significantly. In fact, the top groups produce less than 1/4 the large loss frequency observed in lower ranked stocks. For a strategy built around consistency and risk management, that's a meaningful difference. Several key factors have emerged as particularly important. Institutional ownership has been one of the strongest indicators. Stocks with greater institutional sponsorship often benefit from deeper liquidity, broader ownership, and more stable trading behavior. Price relative to average true range, or ATR, has also proven valuable. Stocks with higher price to ATR ratios tend to experience smaller percentage price swings, creating a more favorable environment for option sellers. Short interest is another key metric. Stocks with lower short interest have generally produced better risk-adjusted outcomes and fewer unexpected price shocks. And finally, implied volatility relative to historical volatility helps identify situations in which option premiums remain attractive without requiring excessive price risk. The research is still ongoing and additional metrics are being tested. The objective isn't to create a complicated black box model. It's to identify a handful of factors that consistently improve stock selection while keeping the process transparent, repeatable, and practical. The Bull Strangle Strategy has always focused on process over prediction. By continuously refining stock selection and stacking small advantages over hundreds of trades, the goal remains simple: improve consistency and build a meaningful edge over time. Before you go, continue your Bull Strangle journey. Visit bullstrangle.com to receive weekly stock selections, option selling opportunities, and ongoing research designed to help investors generate consistent income. For a complete step-by-step guide, pick up a copy of the Bull Strangle Strategy, which is available on Amazon. Research, discipline, consistency, income. Thanks for watching, and we'll see you next time.